Namaste everyone. Welcome back to Paisa Forever channel. Today we are diving into a topic that has completely transformed from a buzzword into a cornerstone of the Indian financial market. If you've been looking at your portfolio lately and wondering if your money could do more than just grow, if it could actually make a difference, then this video is for you. We are talking about ESG investing. Now I know what you might be thinking. Is this just another corporate PR stunt, or will my returns suffer if I try to be ethical? Well, as of late 2025, we have the data to answer those questions once and for all. In this deep dive, we're going to look at why ESG is taking off in India, the strict new rules SEBI has put in place to protect you, the reality of how these funds perform, and how to spot greenwashing before you invest a single rupee. Part 1. What is ESG anyway? Before we get into the numbers, let's get our basics right. ESG stands for Environmental, Social and Governance. Environmental E, this isn't just about planting trees. It's about how a company manages its carbon footprint, greenhouse gas emissions, waste management and energy efficiency. Social S, this looks at the human element. How does the company treat its employees? Is there gender equality? Are the working conditions safe? What is their impact on the local community? Governance, G, is all about leadership. Is the board transparent? Are there strict anti-bribery and anti-corruption policies? Do they follow the law or are they cutting corners? In short, ESG investing is about choosing companies that are committed to sustainable growth and responsible behavior. It's a move away from just looking at profit to looking at the triple bottom line: people, planet, and profit. Part 2. The ESG revolution in India. You might be surprised to learn how fast this is growing right here at home. In early 2020, India's ESG-themed mutual funds had about 2,747 crore rupees in assets. By mid-2025, that number surged to nearly 11,000 crore rupees. Why the sudden interest? Well, it's a mix of a few things. Global commitments. Under the Paris Agreement, India pledged to invest $2.5 trillion by 2030 to meet climate goals. International confidence. Global investors are eyeing India. In fact, some international ESG funds have allocated an average of 25% of their investments specifically to Indian equities. The COVID effect. The pandemic was a wake-up call. Investors realized that companies with strong ESG practices often have better reputations and are more resilient during a crisis. Part 3. The new rules of the game. SEBI's BRSR. If you're worried about whether you can trust the green claims companies make, I have some good news. India's regulator SEBI has become a global leader in making these disclosures mandatory and verifiable. Gone are the days when companies could just write a nice feel-good story in their annual reports. We now have the BRSR, Business Responsibility and Sustainability Reporting. Initially, this applied only to the top 1,000 listed companies, but it has evolved rapidly. Here is what you need to know about the current landscape in 2025. BRSR Core. This is a subset of 49 key performance indicators that are especially critical, like energy footprints and water usage. Mandatory assurance. For the top 250 companies, these reports can't just be self-certified. They must undergo reasonable assurance or assessment by an independent third party. This means an auditor actually checks the data to make sure it's real. Value chain reporting. This is a big one. Starting in FY 2025-26, the top 250 companies have to report on the ESG practices of their value chain partners, basically their major suppliers and distributors. This ensures that a company isn't just cleaning up its own act while its suppliers are causing environmental damage. Part 5. The 6 strategies for success. When you go to buy an ESG fund today, SEBI mandates that the fund must tell you exactly which strategy it is using. There are 6 specific categories. 1. Exclusionary. These funds avoid sin stocks like tobacco, alcohol, gambling or fossil fuels. Integration. Here, fund managers look at ESG factors right alongside financial data to find risks and opportunities. Best in class. These funds pick the top ESG performers within each industry. They don't necessarily exclude whole sectors, but they only buy the cleanest players in each one. Impact investing. These aim for measurable, real-world positive change, like funding renewable energy projects. Sustainable objective. They focus on long-term trends, like the shift to electric vehicles or water conservation. Transition. This is a very Indian context strategy. It focuses on companies that might be brown today, like cement or steel, but have a clear, verified plan to become green. Part 6. Let's talk performance. Does good mean growth? Now let's address the elephant in the room, returns. Many investors fear that by limiting their choices to ESG-compliant companies, they are missing out on big profits. The data tells a more nuanced story. In terms of raw returns, conventional mutual funds, like large and mid-cap funds, have often delivered robust outcomes that sometimes beat ESG funds. Why? Because ESG funds currently have a large cap bias. Many small and mid-cap companies in India don't yet have the infrastructure to report their ESG data perfectly, so they get left out of the funds even if their stock price is soaring. However, when we look at risk-adjusted returns, the picture changes. Resilience. ESG indices in India have shown they are often less sensitive to market risk. They tend to have a beta of less than 1, around 0.92, meaning they are less volatile than the broader market. The flight to safety. During major market crashes, including COVID-19, ESG investments often acted as a shield, providing better downside protection for investors. Long-term potential. While you might see some short-term fluctuations, the long-term belief is that companies with high ESG scores avoid lawsuits, reputational damage, and regulatory penalties, which saves them massive amounts of money over time. Part 6. The danger zone. Spotting greenwashing. As an investor, you must be careful. With all this green money flowing in, some companies are tempted to engage in greenwashing, which is basically overstating or misleading the public about how green they really are. A 2022-23 study of the Nifty 50 companies found that 54% showed some level of greenwashing behavior. Who were the worst offenders? Generally, companies in the energy and manufacturing sectors where it is harder to balance traditional business with sustainability. Who was more trustworthy? Companies under the Tata umbrella consistently showed lower greenwashing scores thanks to a strong history of corporate governance. How can you spot it? Check for cherry picking. Is the company only talking about its social charity work while ignoring its massive carbon emissions? Look for real data. Generic labels like eco-friendly or natural are red flags. Look for specific, measurable metrics verified by third parties under the BRSR core framework. Cross-listing. Companies listed on foreign exchanges, like in the US or Europe, often face stricter scrutiny and are less likely to greenwash. Part 7. The top performers in India. If you're looking to get started, here are a few of the major players in the Indian ESG space as of late 2025. SBI ESG Exclusionary Strategy Fund. This is the oldest and largest ESG fund in India. It focuses on excluding harmful industries. It has shown resilience and has an AUM of over 5,700 crore rupees. Quant ESG Integration Strategy Fund. In recent years, this fund has emerged as one of the top performers in terms of returns and risk-adjusted metrics. ICICI Prudential ESG Exclusionary Strategy Fund. Another heavy hitter, currently ranked very high for its ability to generate alpha, returns above the benchmark. Note, as with all investments, please read the scheme information documents carefully. Mutual fund investments are subject to market risks. Part 5. How to start your ESG journey. Ready to put your money where your values are? Here is your 4-step plan. 1. Define your goals. Are you looking for ethical growth or are you specifically interested in a theme like clean energy? 2. Pick a strategy. Decide if you want an exclusionary fund, a transition fund, or a best-in-class fund. 3. Check the ERP. SEBI WOW mandates that the name of the ESG rating provider, ERP, must be disclosed alongside the fund scores. Check these ratings to see how the underlying companies are actually performing. 4. Diversify. Don't put everything into one thematic fund. ESG should complement your existing portfolio to balance your risk and return. Conclusion. Friends, ESG investing in India is no longer about doing good. It's about strategic investing in a world that is becoming more resource-constrained and more strictly regulated every day. While ESG funds might not always be the fastest runners in a bull market, they are proving to be the most resilient ones when things get tough. By using the new BRSR data and choosing funds with clear strategies, you can build a portfolio that reflects your values without sacrificing your financial future. To put it simply, ESG is like the helmet of the investment world. You might feel faster without it when the road is clear, but when there's a bump in the road, you'll be very glad you have it. Thank you for watching. If you found this helpful, hit that like button, subscribe for more financial education, and drop a comment below. Are you already investing in ESG or are you still on the fence? Until next time, keep investing wisely.